You don't wake up knowing markets, kid. Everybody starts brand new. First you learn what moves, what waits, and what risk can really do. No racing clocks, no magic tricks, no get rich overnight. Just learning how to place a trade and sleep cozy and tight. No shortcuts, no loud claims, just rules you understand. Know what you're risking, know your why. Keep a steady hand. One trade at a time, that's how it's done. Slow is smooth and smooth is smart. You learn before you earn, my friend. That's how confidence starts. This ain't a sprint, it's a longer game. So pull up a chair and plan. Welcome to Options for Beginners with Dan.
All right, everybody, welcome. I've got my cohort in crime here, Matt.
Hello.
Coming to you live from wherever we're at, and good to have everybody. And we're going to continue on the journey of, as they say from Chicago, the wheel strategy, and kind of how we might. And again, the whole focus is Matt's going to bring up a picture of the wheel. We'll go over that real quick just to recalibrate those maybe who haven't seen this or been with us. And then we're just moving into the whole question is this: is there a better way to do the wheel? Now, you could say better in terms of what? So I'm focusing on two things. Is there a cheaper way to do the wheel and give you a much better yield potential? With those 2 points, I say, my friend, yes, there is. And I'm going to show you a couple examples of how I would do a wheel. Now, are there logistics when you're learning anything? Yes. And we'll get into that. But starting here, Matt, do you want to, Matt, the good thing having Matt is he's much better giving content than I am and saying it in less in the words. I mean, Matt's has become one of my favorite educators. He does a great, among 50 other things he can do. Matt, why don't you take us through a little bit the traditional wheel and how people.
Yeah. So the wheel is one of the most common strategies for new folks doing options. And there's a couple variations, which we've been talking about doing with stocks and options and also just doing with options. But the idea is simply this. It's a cycle, right? And the idea is that usually it starts with somebody having an amount of cash and they will sell a put. And they will sell a put, and depending on how aggressive they want to be or not be, they will sell a put and collect premium. If they get assigned, they then own the stock, and then they will sell calls. And again, depending on their time frame, how aggressive they want to be, they will collect premium from selling the calls. And the process repeats. Once the calls are sold away, they have cash. Then they sell a put, collect the stock if it goes down, sell calls. What's the problem with this? This sounds like the perfect system. Well, I'll let the viewers know. After the show last week, I was like, Dan, let me tell you some put stories.
Oh, yeah.
And I told Dan a personal story of selling. The reason I said it offline, because it was extremely, for me, a very large amount of puts that I had sold. This is back almost 5 years ago. And I thought this was the perfect strategy. And when my stock went down 30%, I realized how much notional I was going to be assigned. And it was a huge amount. And I got saved by the wheel.
Yes.
Not saved by the bell, saved by the wheel, because the stock went up and I was able to get out at break even. But Dan and I pulled up the stock, which the stock was Cleveland Cliffs. And what I was wheeling was the 20 strike. And if you look at where CLF is now, it is quite below the 20 strike. So 5 years later, would I still be wheeling Cliff? I might still be selling calls, Dan, to try to get my significant amount of Cliff shares called away.
Oh, yeah.
So it's not a riskless scenario, but there's a lot of advantages for beginners.
Yeah. And would you say, Matt, when you talk about the wheel strategy, there's basically two strategies involved here. One is, and I think when we talk about these two strategies, there's two camps with investors, right? They'll either, you talk to people and you say, the wheel, do you understand it? Yeah. But some people will say, hey, Dan, I just want cash flow. I'm just selling puts, right? I don't want to deal with, or they'll sell puts to buy stock, but it's just a simple, just sell a put. It's easier, right? To some people. Now, the negative thing with selling puts is if we go up too far, you'll say, oh, geez, I just got $2 on the short put. The stock's going up $30. I wish I was long the stock. So some people are in the camp of short puts for cash flow. That has its pluses and minuses. And then the other people you'll talk to a lot of people. You'll say, do you do any short puts? No, but I do covered rights.
That's right.
Covered rights or buy rights, buying stock and selling it out of the money call. So you have two main strategies in the wheel, but I see with investors, two camps. Matt, would you say from the investing part of the portfolio, long delta, have you done more, would you say in part of the wheel, sold more puts or been involved more with covered rights or buy rights?
I have sold, here's the answer. Personally, I've sold more puts, and it probably should be the opposite. Because I'll give you an example.
Yeah.
I have a stock that I've been long for quite some time. It is, I'll just tell the ticker. It's SBSW. They are a miner.
SBSW. Okay.
It's $17.
Okay.
And it was, let's just say I've owned it for a few years.
Okay.
And it was down in like the $3 range.
Oh my goodness.
Yes.
Oh my goodness.
This is real. So it's up 2% today, but not that long ago, it was over $20. And the reason I'm telling you this story is I knew when it got to $20, I almost sold out of the position because I've owned it. It's a cyclical, fundamental based. It's not a meme.
Yeah, real quick, can you explain?
Yeah,
I could have sold out of the position.
Yeah, I could have just put a sell order into the position, and indeed, I've been selling it because I had a decent chunk and it's run up a lot, so I've been selling it as it goes up.
That means sell the stock and buy the short calls.
I've been just selling the stock, and what I should have done is I should have just wheeled out of it. I should have just used covered calls or covered rights, and instead of having a sell order for, say, sell 100 shares of this, I should have just sold a series of calls because I'm not in a hurry.
Good point.
I did want to take profits, and that would have been a smarter way for me to take profits. So like right now, stock's at $17. If
You're just long the stock, you don't have any.
I'm just long the stock.
I get you.
But like, here's the thing. If I wanted to, I could sell that 21 strike for March. Or there's a 21 strike for March.
Yeah.
I could sell that and that would function as a limit order for me. If it goes back up there and gets called away, that would do the same thing it did. What's the advantage? Well, I could pick up a few shekels selling the call as well.
Right.
And so to answer your question personally, I've done a lot more CSPs. I've done plenty of covered calls. I'm just I don't have a good reason I haven't done them lately as much. I think, to be honest, Dan, telling on myself, it's because the market's been really volatile. And I trade in a lot of these aren't meme stocks, but they're high beta names. I mean, like I said, it's probably moved 25% this year already, the range, or maybe even more, maybe even 30%. So the trick with covered calls is when I've been successful with them, I just put them in and treat them as limit orders.
See, that's a great way. So it's really kind of, would it be fair to say, Matt, you'd be using short calls as a structured way to scale out of your trade on the upside?
That's exactly what I'm saying.
Okay. Whereas if you're saying, even though what Matt's saying is he's just long the stock. So just he's doing better. I mean, he's doing well on the stock.
Yes.
But you're saying it's not as, it's a little iffy. When do you sell out? Whereas if you have these calls staggered up, it gets you out in a very disciplined way.
Yeah. So like in this example, to bring up a graph, I mean, I could have done, let's see, can you guys see that? Yeah, I could have done something like this, or I could do something like this and, pick up a little bit of money, sell. This is a March 20th. So,
Yeah.
a little less than 6 weeks. If it gets, the stock's at $17 right now. If it doesn't go anywhere, I made some money.
Yeah.
If it goes down, I made some money. I'm not planning on selling the stock. So like, this is something I should do more of. Like I said, I'm telling on myself, Dan.
Yeah.
As an educator, one of the best ways to hold yourself accountable is to teach something. And then you realize, oh man.
Oh yeah. Well,
I should probably start teaching nutrition, Dan. I'd probably get better.
No. I get you. It's like the carpenter who's the carpenter, and he comes home and there's holes in the wall. And you say, well, why do you have holes in the wall? Well, I didn't get a chance to,
Right. I was working all day. Somebody else.
You didn't get, but anyways, well, folks, we're going to, with that preview, we're going to look at a couple examples of how to look at diagonals, and we're going to go into Microsoft, right? So Microsoft, a couple nice things about Microsoft. Number one, we talked on the Option Omega show in the morning today. So if you don't ever get a chance to see it or didn't know it existed, every morning at 8:45 Eastern, we have a free show. It's usually Matt, myself, Troy, and Rusty comes on sometimes. And what's wonderful is we go over back testing. We solve a lot of life's problems at the beginning. We'll talk about things that maybe don't have anything to do with options, but we have a lot of fun with it. But always a good back test. Today we talked about we did a back test, but as I get older, it's funny. I'm trying to think what we back tested an hour and a half ago, and I can't remember. So
I think maybe some double calendars, huh?
Yes, double. Oh, thank you.
There you go.
What I was getting at is double calendar in Microsoft, and we are excited. Rusty came out from Option Omega and talked about that was the first stock they're putting in for back testing, and we were getting more excited talking about it because of the possibilities. But anyways, so we're going to look at Microsoft today. It's down $9, right? And it showed, again, just a little bit of perspective. Microsoft's come from $513 in the middle of November, and now it's at $403. So it's down about $100 or 20% since November. It showed life, except for today. The last 3 days, it went up about 8%, and now it's back down. So let's start with the premise for any of this. When we say cash, sell put, cash secured put, or some type of covered right strategy, the whole thing is, hey, you're taking the premise, I like the company, I buy the stock for, Joe's college fund in 3 years, or, you like the company. You're not going to just, like if Matt owns Microsoft stock, the minute it goes down, he's not going to sell it out. That would be insanity, right? He's buying it more. Right. He's not buying it for a week, right? So the one thing I want to mention is, again, I'm going to talk about diagonals today. I'll quickly explain that. But remember, this is an alternative to a buy right or covered right. And just remember, if we do a buy right or covered right in Microsoft, whatever call out of the money you sell against it, you're buying 100 shares of stock at $403. So if you do a buy right and you sell an out of the money call at whatever, $2, $3, $4, $5, you're putting up 40 grand, right? Let me say that in 3 different languages. You're putting up 40 grand, whether you have it or not, right? And so all we're looking at is, remember, 2 things. How do we do some kind of substitute for a buy right or covered right for much less capital and a higher potential yield? That's what we're trying to solve here. So I'm just giving you 2 flavors of it today. Okay. On a down day, would I do this in Microsoft because it's down? No, I wouldn't. I would do it in Microsoft because it's down to the 403 level. And regardless if it was at 403 today or 420, I like it long term. That's why I would do it, right? Now, assuming we get past the first hurdle and say, Dan, I don't mind being intentionally long some deltas in Microsoft, because if someone is at home and they own Microsoft stock and you're not selling it out today, you'd be a candidate for this. So the example would be, I'm going to give you two flavors of this. One would be I'll just give you two of them. So first one would be, we're going to buy the April 17 and sell the Feb 20. Buy the April 17 400 call and sell the Feb 20 405. And then I'll let Matt model this and we'll talk about this. Will be in the calls, all calls, buying the April 17 405 call. That's going to be about 65 days out, folks. And again, you can go different durations. I'm just picking in this 65 days. And I'm selling a 9-day Feb 20 405 call. Could you sell 2 weeks out or 3 weeks? Yes. But here's what it looks like, right? So this is, you look at the graph and you say, this version doesn't look exactly like a covered right. It's in the covered right family. It looks kind of like it. But the key to remember is this is called a diagonal. And you say, well, what is a diagonal? A diagonal is just a mixed month spread. You're buying the further out, selling the call. Oh, Matt, I'm sorry. This is calls.
My fault. User error. Here we go. This is going to look a little bit different now.
All right, good. All right. So that looks that looks like now we're getting more towards the covered right. And this is a long delta.
That's right.
Trade. Matt, can you bring the Greeks in there for a second?
Sure.
Let me see.
Here's
that lower, I'm only seeing on the screen.
These right. I got them up there.
Oh, there they are. I'm sorry. So the deltas are 8.8 deltas long. So a little bit long, but nothing crazy. All I'm doing here, folks, is I'm buying 65 days out, and I'm buying one strike in the money. That's it. And then I'm going 9 days out, Feb 20, and I'm going to sell the next strike up, 405. 405. So I'm trying to keep it, and this is 1,578. I'll let Matt kind of go through the modeling, but I want to just mention one thing. The thing to keep in perspective is, you'd say in a small account challenge, let's say I wanted to put $500-600. It's a little bit beyond that. But think about what we're doing. This is something kind of as an alternative to a $41,000 covered right?
That's right.
That's the realm to think of it. So, so anyways, Matt, why don't you go over that a little bit?
Yeah. So basically what happens is it's a long delta trade. And as we move through time, the short call is going to expire on the 20th, right? That's the end of this. And this is what the payoff graph looks like at the 20th. Is this kind of what you wanted to see, Dan? So you have a decently wide tent to the upside. Yeah. Again, Microsoft can move quite a bit.
Yeah.
And you've got a little bit of room to the downside. Where is the best place for this to be? It's finishing right below the short strike, probably.
Yes.
And then you keep selling calls against it.
Yeah.
Or if you maybe a little bit past the upside, somebody probably would take assignment, but a little bit on here on the downside, you would get a nice return.
Yeah.
And then you would still have your call, and then you could sell more calls.
Yeah. And you have room beyond 405 to the upside.
That's right. Quite a bit.
Yeah. In this, now, folks, I'll call this like you're buying it in the money. Again, we're trying to keep it cheap. So there's only 5 points difference between the long and the short. With this trade, I'm basically, I'm not that long deltas. This is, what's the deltas on this one?
Well, let's reset it back.
Oh yeah, reset it. Yeah.
So it's just shy of 7.5 delta now.
And just for perspective, how little deltas this is, folks.
Yes.
If Matt were to do a covered right and buy 100 shares of stock goes up every dollar, you make $100. So it's a 100 delta. And let's say you sell an out of the money call, a 20 delta, which is typical covered right, or a 30 delta. You're going to be like the difference, 100 from 20, 80 deltas long or 100 from a 30 del to 70. So most people who do covered right, whether you know it or not, folks, you're pretty long. If it goes up, you make $70, goes down, you lose 70. Someone that would do this type of a long diagonal would say, you know what, Dan, I want to do a positive theta trade. There's 2 months between the long and the short. If we go up, I'm probably going to get the money, right? And you could get a pretty good yield, right? Unless we go up too far. But this person's a little conservative in that they're putting up $1,580, but if it goes down, you have a break even, right? And this one, you have a break even of like, and again, break even is where at expiration where the graph crosses zero. Somewhere around, you got like 395, Matt? Is that what you show?
Yep, 395 right
395. So that's at least $9 lower than we are, right?
Yeah.
So it's a little more conservative. You're not swinging the deltas. You're saying, hey, there's a down day today. I want to get long. A little more conservative, right? You're only, and again, it's positive theta. And you say, well, Dan, what would be the goal here? Make probably 10 to 20% on this in the month. Now, you say, Dan, is that normal? I would say what you're looking for with these, because again, remember, it's much cheaper. This is a $15,000 diagonal, $1,500 versus a $41,000 covered right. A covered right, if you ask people historically, what's a decent yield for a covered right? 1%.
Yeah.
Right? A month would be conservative. Why is this more? It's more because it costs less. Yeah. So one thing I want to get out right across, so risk management, because there's 2 months between the long and the short, if we go down, right, what could you do? Same thing you do with a covered right. I can roll my short call down, out 7 days at the same strike, 405, or what I could do, roll it means just buy in my short call, go 7 days further out, and keep selling calls against it to pay for the cost of the long. That's kind of the theory, right? Yeah. And if we go down, eventually, if we keep going down, I could sell the 400 call and then turn it into a calendar, right? And which would reduce my capital. But so you're selling by keeping X amount of room between the long and the short, you have sells that you can do against long. And people do this with a covered right, Matt? I mean, they long the stock. If the market goes down, they might roll the call out to the same strike, out meaning further out in time, or to a little bit lower strike. I never want to go below. Generally, I don't want to go below the long call, because then it's a different animal, right?
It's a different, different expectation, right?
But let me just tell you the another version of this, which would be about the same cost, but both options will be out of the money. And shout out to two people in our community, Amit and Anthony, who do a lot of these things more than I do. But here would be a more bullish one: buy the 405, sell the 410. So this is going to be similar capital, right? Relatively, $1,500, right? Similar. But as you open it up, you notice instead of being 8 deltas long, we're double, right? We're 16 deltas long, right? Roughly same amount of capital, but now instead of having a break even of 395 on the downside or 394, your break even might be what, 398 or 3?
That's right, 398.
398 on the downside. So, but on the upside,
you got a little more room.
You get a good upside. You can make 10, 15% in a day.
Yeah. There's that's
here.
Most of the profit tent is around, I would say, 15% here.
Yeah, and again, is this exactly like a covered rate? No, I tweaked it a little bit, but the goal is make it much cheaper, right? On this. So in a way, you're managing it on the downside, similar you would a covered right. But instead of putting, I don't mean to be over and over, but instead of putting up 41,000, you put up about $1,500, right? And again, we could answer, I think as we get into the next class Friday, I'll get more specifics of these, or if you have any questions you want us to answer. Matt, anything on the modeling of this one that you?
No, I mean, I think it's super interesting to play with. And you can, I mean, the other thing you can do is like if we just push this short call out another week, so we
Yeah,
do like
good point.
give yourself a little more room, you can continue to bring the cost down on it. Let's push it
Oh,
out another week after that.
yeah,
23rd. Well,
right.
now you've taken, look how much bigger the profit 10 is. Now, what's the downside? You're in the trade a lot longer, right?
Yes. Yeah.
But it's a lot cheaper, bigger target. So I think these strategies, Dan, these like, I've heard these type of things. This would be like a poor man's covered diagonal or something.
Yeah. Poor man's covered. Yes. Some of the terminology, poor
Yeah.
man's covered right. I would call it a long diagonal.
Yeah.
Long being, it's a debit transaction. It's long vega. And you say, well, what does that mean? What's nice about long vega, your risk on this or a covered right is to the downside. But unlike a covered right, that long vega means it's basically going to be like if you're a truck going through the Smoky Mountains, and when you're going downhill or up downhill, they have these bumpers that you can, if you're going too fast, you ever see those things on the side? So it'll slow it down like bumps or something. Well, that's what this is. By being long vega, are you going to lose money on the downside because you're long deltas? Yes, but you'll lose. Sometimes you could lose on a big move down less than you thought. Why? Because Matt could take if you took the volatility up because you're long vega and we go down, it'll take a little bit of the sting out of the downside for you.
And I just love that you can. So I mean, I'm really changing the trade. So now you're in this, like this is over a month, but the price is half of where we started. And here's the other thing. If you make it that whole trade, which you don't have to, you're 10. I mean, you're more long delta, right?
Yeah.
And despite it being cheaper, you have a pretty big upside window. And the other thing, Dan, is if you get any upside movement at all in this, I mean, people manage these trades all the time, right? Like any upside movement, or as long as it doesn't go down, time is on your side, right?
At least and you can make it, you can, and again, to get time on your side, you could put your long out a year.
Yeah.
You could put your long out 2 years, whatever you want, because in a way it's the same, if you just want it to be cheaper than a covered right, but have the same feel, take the long out a year or two, right? And then you're selling calls every week, or you can do it every 2 weeks. That's or like Matt was showing, you could do it every 3 weeks or whatever fits your schedule. But the idea is the big thing is, and these are in stocks, Microsoft's, it's not like an Enron. Wouldn't you agree, Matt?
This hopefully not.
Yeah,
I don't think it's going to zero.
This is a real stock.
Yeah.
We have more savings than most countries.
That's right. Yeah. Higher, yeah.
So anyways, one last thing, folks, I'd want to encourage you. If you said, hey, Dan, where can I kind of AAA baseball get practice with these? One area, I like, dealing with Microsoft and they have it in the modeling. You got all these stocks in the modeling tool, but you can back test things. But what I like is if you look at some of the sectors in the SPX, right? That is like the AAA ball club for baseball. It's like minor league, because if you look at the sectors in the SPX, what I like, Matt, is talk about cheap. You could do cheap diagonals. I'll just read a couple of them to you. XLK, the biggest piece of the SPX, $142. Microsoft's $400. So it's a lot. You do a diagonal in XLK.
Yeah.
It's cheap. XLU is $44. XLC, $116. XLY, $117. XLP, $88. So if you really want to, you could do these diagonals for $300.
Yeah.
Right. And get a feel of it. So I might say, hey, start in there, then work your way up to, a Microsoft $400 stock. But, as Matt showed, which is a great thing.
Here, let me
By
look at.
taking your short out 3 to 4 weeks against your long, you're reducing the cost of it.
Yeah,
Matt, go
I'm
ahead. So yeah, this
I'm playing around. I'm
no,
playing
no,
around
that's
with some right now. Let's make
yeah,
it a little bit. This is pretty far out.
yeah.
Let's do May, and we've got a one. I just pulled up XLK.
No, that's great.
And we'll do kind of like a little more bullish one. There's probably what, $5 or $6
Yeah.
here. Yeah, five. There we go.
And before
550. Pretty
Matt
good, guys.
models it, I want him to go over this. I just want to
Hmm.
make one point. Here's I think something people miss out on. And this gentleman I was telling you about, me, what you can do with these, we always think of covered rights, they're for the upside, right? And you do it in the calls. But you can do a long diagonal on the put side. In other words, do good stocks or good ETFs ever go down? Stupid question. Of course they do. So you can do XLK, kind of a buy right or a diagonal for the upside, but you could do it for the downside.
That's right.
Even if it's for, okay, XLK, it's made a big run up or whatever, you can go both ways on this.
Yeah,
And so-
here, let me model one to the downside. We probably,
Yeah.
let's see. Something like this, maybe, Dan. Okay.
Yeah,
let's
what
see.
strikes, you're buying the 145, selling the 140. Yeah, something.
I got them the other way around, so we probably want
So
to do
puts, yeah.
this in puts.
So you buy the 145, sell the 140 would be one version.
Yeah, here. This is probably more what we're looking at. Like,
Yeah.
So, and then so this again, we're just doing this on the fly. This is like a 1 month, 3 month play, basically.
Yeah, yeah.
So we move through it. If you like, this can still have a pretty nice return and gives you a decent range, Dan. I mean, this would be a more bearish take, but
Yeah.
if you think it's due for a pullback, you've got a range of like what, 148 all the way down to 125. So like, listen, that's not the smallest target out there. That's a little bit of a target.
No,
You
pretty
guys-
good. And
and
you're
you
only
can change any of these.
Yeah, Matt, take the date all the way back to zero. You're only, you're 11, 10 delta short. I mean, and it's cost you, again, what's wonderful is $480, right?
Yeah.
And it's cheap. And if you wanted to do an out of the money one real quick, it would be something like buy the 140, sell the 135.
Buy the 140
and sell the
the
135. This would be an out of the money long diagonal. It'd give you, basically you're paying about the same price for double the deltas, or a little more deltas.
And look how much room you have with that. I mean, this is.
Yeah. And again, you can, and the other thing with these diagonals, what you can do is, because people say, well, I don't know when it's the bottom and I don't know when it's the top. Join the club.
Yeah.
None of us do. But
if you do, let us know. Please.
Let us,
Your first call is Dan. Your second call is me. Let us know.
Yeah. Or just call us both together. But the other thing you can do, folks, is scale. Okay. Hey,
yeah.
I'd want to put $1,500 into this trade. Start out one, scale. And if it goes against you, you can add them, right? It doesn't have to be, all at one time. So, well, folks, I appreciate anything else, Matt, you want that we forgot you want to add?
This is great. The thing that's cool is when you use the modeling tool, you can, Dan, you can assign your bias to a certain weight. What I mean by that is, how bearish are you? How bullish are you?
That's right.
And that's I spend all day talking about options, working on software about options, helping people understand software about options. And it's working in it all day. It's like, sometimes I still forget how powerful and how simple they can be. And it's things like this that make me think, man, if I just had a couple hours to sit down and map out some of these individual equities that I have a thesis on, you can structure these things in a way that really lets you use the power of options and manage your risk.
Yeah, it is. It's, I think these are powerful strategies, and what I'm excited about, you can do them much cheaper, right? I mean, the world of covered rights and cash secured puts can be very prohibitive. It's like joining a country club, right? It can be very expensive. And so these are strategies that, again, cheaper and better yield. So we'll continue the course on Friday. Thanks again, Matt, as always, for driving the boat. and helping out with the analysis. And we'll see if you have any questions, you can send them into the show, send them into Matt. We'd be happy to answer any questions. Matt, where could they do that?
I mean, most people just leave a comment on the YouTube video, which is fine. But you can also just hit us up on the Discord. We need to set up an email address for people to email show questions. So I may try to do that as well. So,
well, thanks everybody. Thanks, Matt. And we'll see you next time.